Welcome to Osborne Moreno's Tax Talk. Today, we're going to be talking about cost segregation studies and how to maximize depreciation deductions. Let's take a closer look at how depreciation works. Let's say you buy a building to rent to tenants. You'll sign a single contract to take title to the property, and you may think of it as a single asset, your rental property. But if you're actually buying a whole collection of different assets, the land itself, the building that sits on the land, and the stuff inside the building. Tax laws treat those assets differently, and the way you report those assets on your taxes can make a huge difference in the amount you can depreciate. Start with the land. Raw land doesn't wear out, doesn't need to be replaced, so it's not depreciable. And that in turn suggests that you want to allocate as little of your purchase price as possible to raw land. There's a couple of ways you can determine that amount. Your tax auditor will assign a land value, and your appraiser may assign a different value. So you can pick which one works better for you. But even the land is a collection of assets. There's the land, and there are land improvements, driveways, sidewalks, landscaping, pipes to and from the street, driveways and sidewalks crack. Landscaping needs to be replaced, and pipes deteriorate over time. So you can depreciate land improvements over 15 years. Too many tax professionals fail to break out those assets and cost their clients substantial deductions. The same principle applies to the assets that make up the structure. It's not just a single asset. You've got structural components that are permanently affixed to the property. These are governed under Code Section 1250. These assets depreciate over 27 and a half or 39 years. And you've got personal property included in the structure governed under Code Section 1245. Those assets depreciate over 5 or 7 years. The principle here is the same as with land improvements. If you can break out the 5-year components, you can depreciate them faster to increase your deductions in the early years of ownership. Personal property includes all sorts of assets not permanently affixed to the structure that you can break out to accelerate your depreciation deductions in the first years of ownership. Cabinets and countertops, appliances, flooring and carpeting, window treatments, molding, lighting, wiring inside the walls, security and sound systems as well. But let's take a look at some numbers to see how much difference we're really making. We'll say that on July 1st, you pay $600,000 for a 4-family rental property. The date's important because your first year's depreciation is based on your purchase date. Now, per the county auditor, $100,000 of that value attaches to the land. The remaining $500,000 depreciates over 27 and a half years. If you forgo cost segregation, you'll deduct $8,333 a year in year one, and then $18,182 per year for years 22 through 27, and $9,848 in year 28. Now let's see what happens with cost segregation. We'll assume you can shift $20,000 of the $100,000 land allocation to land improvements, which depreciates over 15 years. We'll also assume you can shift $100,000 of the $500,000 structure to personal property, which depreciates over 5 years. As you can see, cost segregation produces significantly larger deductions in your first 6 years of ownership. You'll deduct $16,444 in year one. That's nearly twice as much without cost segregation. And you'll deduct $35,879 in years 2 through 5. Again, that's nearly twice as much without the cost segregation. And you'll deduct $26,712 in year 6, still significantly more. Once you reach year 7, your deduction actually drops. And this example goes from $18,182 to $15,878. That's because cost segregation isn't primarily about creating new deductions, except where you shift from non-depreciable land to depreciable land improvements. And we'll discuss how it works further on. Cost segregation offers another benefit by separating out the components that make up the structure from each other. When you replace those components, you'll be able to write off any remaining undepreciated basis in them to offset the cost replacement that assets you can't immediately expense. I know it's a mouthful, sounds complicated. Let's say you buy a 4-family rental apartment building for $600,000 again. Naturally, includes a furnace. 2 years later, you replace it for $8,000. The furnace is a permanent part of the property, so you'll depreciate it over 27 and a half years and deduct $291 a year. But what about the old furnace? You're still depreciating it. as part of your original 600,000 for as long as you continue to own the property. Now, in contrast, let's say you do a cost segregation study. The appraiser signs off on the value of 5,500 to the original furnace. You break it out from the rest of the structure. In your first 2 years, you depreciate $400. But this doesn't give you a bigger deduction because you subtract that 5,500 from the overall 600,000 that you pay for the building. But when you replace the furnace, you can deduct the remaining undepreciated $5,100 as abandoned property. It's not the same as expensing the $8,000 you pay for the new furnace, but it's a lot closer, and it gives you the use of the tax savings on the remaining $5,100 now, rather than waiting another 25 and a half years. Obviously, the best time to do all this is when you first put a property in service. What if you didn't know you could slice and dice your property into separate pieces like this? The good news, a cost segregation study can work like a tax time machine. You can go back, calculate how much deduction you've missed by not taking out your personal property, and catch up all of those deductions, in a single year. Mechanically, the time machine takes the form of a change in accounting method. You don't have to go back and amend all your previous returns. In fact, if you place your property in service more than 3 years ago, you can't. Instead, you'll file a form 3115, which is an application for a change in accounting method, and use part 4 of the form to report your catch-up election. Technically, it's a section 481A adjustment. Now, the first thing you need to know about cost segregation is it generally doesn't create more deductions. It takes assets you would have depreciated anyway and accelerates them from 27 and a half or 39 years to typically 5 years. In some cases, you'll take the land improvements that you might not have depreciated at all and turn them into 15-year property. Of course, those deductions are generally worth more than they would be decades from now because they give you the use of the savings now. So we're talking about the time value of money. Full-blown cost segregation studies generally start making sense for buildings valued at $500,000 or more. However, several providers offer online software that analyze 1 to 4 family residential properties up to $500,000. The amount you reclassify typically starts around 5% for buildings like warehouses that don't include a lot of personal property, like carpeting or window treatments. That percentage goes up to as much as 40% for properties like medical offices with elaborate improvements or high-end retail. Cost segregation is most valuable for newer properties that haven't already taken significant depreciation deductions. These typically start around, $5,000. Can we put this in here? Now, I'm going to redo this. I'm going to redo this slide. Now, the first thing you need to know about cost segregation is it generally doesn't create more deductions. You would have depreciated them anyway, but it accelerates them from 27 and a half years or 39 years to typically 5 years. In some cases, you'll take land improvements that you might not have depreciated and turn them into 15-year property. Of course, those deductions generally worth more now than they would be decades from now because you get to use the savings today. It's called time value of money strategy. Full-blown cost segregation studies generally start making sense for buildings valued at $500,000 or more. The amount you reclassify typically starts at around 5% for buildings like warehouses that don't include a lot of personal property, like carpeting or window treatments. And that percentage goes up for as much as 40% for properties like medical offices with more elaborate improvements. Cost segregation is most valuable for newer properties that haven't already taken significant depreciation deductions. These typically start around $5,000 and typically fall between $10,000 and $25,000. Here's how it works. Most vendors start by running the numbers with a substantial study. It involves looking at the building's original basis. Then they estimate the percentage of the assets they reclassify. This usually involves looking at what a type of property you own: warehouse, residential, retail, office. Next, they look at your existing accumulated depreciation to ensure you haven't already depreciated too much to make a significant difference. They estimate for your actual savings based on your federal and state taxes. If the savings they estimate are enough to justify a full-blown study, they'll quote a fee and you'll make a go or no-go decision. If you decide to go, they'll send an engineer out to review your blueprints, mechanical, electrical plans, and similar documents. They'll physically inspect your property and they'll allocate the cost. And then they'll create a study. The study details everything. And finally, you'll deduct the adjustment on your personal return. There are three more opportunities to consider. For most local governments impose property taxes on real estate, but not on personal property. When you reclassify assets from real estate to personal property, this lowers the value subject to real estate taxes. If you're in a high enough tax bracket for ordinary income, conducting a cost segregation study, the year you sell the property can lower the amount your income that is subject to tax at ordinary rates and shift to income treated as long-term capital gains. Finally, your heirs can use the study to create a one-time adjustment in the year you die. And that won't do much for you, but it'll be a nice little bonus for your heirs on your final 1040. Remember, the property gets stepped up in basis at your death, so nobody has to worry about recapturing the extra depreciation for studies. So what's the downside? If you choose to sell your property, there will be more depreciation to recapture. You'll also have to shift much of that depreciation from Section 1250 property to Section 1245 property, which is taxed on a recapture at an ordinary income tax basis. You can avoid immediate tax with the Section 1031 exchange or reinvestment in a qualified opportunity fund. I hope you found this helpful. And again, at Osborne Moreno, we provide tax preparation and tax strategy for small business owners and investors. Thank you.